This is the biggest lie you probably believe in the stock market. Believing this lie is the reason you are going to stay poor. So in this video, I will be debunking this lie and telling you 4 ways you can make money in the stock market.
Is it Brian? Yes.
Hi, I'm Matt Janino. I teach you how to make money, grow money, and invest money. So please like this video and subscribe to my channel. I would greatly appreciate it. So the stock market was designed to transfer wealth from the poor to the rich, and it doesn't seem fair, and it happens in multiple ways. And the sad part is it's probably happening to you right now without you knowing, because every day investors are being taken advantage of. The most exciting IPOs like Uber and Lyft are just meant to lure investors in with the hype, giving early investors and longtime employees a place to sell their overvalued shares to people who do not understand investing. Retirement account managers who have no idea about the stock market and investing are charging you daily to manage your hard-earned money. What are you doing? News comes out almost by the minute trying to get you to sell and buy at the exact wrong times. Let's stop this right now. Let's stop people from taking your hard-earned money. If you know how to play the game, you will know how to get to the other side. The side where you can grow your money smartly and not get taken advantage of. Stand up for yourself today. Watch the whole video as I debug the most popular investing lie you most likely believe. And here is the lie you believe in the stock market, and it is that you cannot beat the market. You can't beat the general returns of the index funds. If you don't know what this means, the index fund returns 7 to 8% per year on average since the beginning of time. And most people say you can't beat that. You can't make more than the index. This return of the index is what we call the benchmark. This is what every investor shoots to beat every single year. If you can get more than 7 to 8%, you're considered a good investor. If you can't, if you get 3 to 5% or underperform the index for that current year, you're considered a bad investor. So everybody will tell you that you cannot beat the returns of the index, especially in the long run. And today I'm here to tell you that those people are completely wrong. You can beat the index in 4 separate ways I'm going to tell you about in this video. And with these 4 ways, anybody can beat the index. I can teach your grandmother to invest and beat the index over time. All it takes is a little bit of knowledge. And here's why it's so easy to beat the index. So the SPY 500, you may have heard of it, is one of the most diversified indexes out there. It holds 500 stocks. 500 stocks is way too much. Diversification is dead to the new age investor. Most of the best investors in history hold between 10 and 20 stocks. So having 500 is not in line with what the best investors do. And those best investors are beating the index consistently year after year. Just for example, Warren Buffett owns 17 stocks right now, and he's considered the best investor of all time. The reason why owning stocks is actually bad is because if you own 500 stocks, you most likely own a lot of bad stocks. Just for example, in the SPY 500, they own GE, and GE is down 40% in the last couple years, and it's been cutting its dividend. The crazy part is Warren Buffett even owned GE. But what Warren Buffett did is he sold GE at the absolute top when he knew it was fundamentally crumbling. So here's the main difference. Warren Buffett sold GE at the top, and the SPY 500 held GE all the way to the bottom as it's been cutting its dividends. So smart investors can realize when they should get out, while the index holds bad stocks for long periods of time. So if the best investor in the world dumped GE and your precious index held onto it, what are you investing in? Just another example is the SPY 500 actually owns some retail stock, and we know retail has been slowly dying the last couple years. It holds L Brands and Macy's, and those stocks are down 70% and 90% in the last couple years. I think you get the picture when you're holding a bunch of stocks and you're holding A lot of stocks that are tanking like Macy's and L Brands, if they're down 70%, the average return you can have of all your stocks is much lower. This is the sole reason why the index fund is beatable, is because it's holding a lot of bad stocks. So let's stop investing in watered down returns and let's look towards these 3 ways to beat the index fund safely over time. And the truth about the index fund is the index fund is a bad investor. I sold GE, Warren Buffett sold GE, almost every investor got out of that stock at $30 and $40, and now it's down to $8. The only person that held that stock all the way down is the index fund. The index fund is a bad investor, and you, with just a little bit of knowledge, can beat the index fund and be a better investor over time. And you're probably asking, how am I going to do that? How is that possible? And right here, I'm going to give you 3 ways to beat the index fund easily and safely over time. And the first way to safely beat the index fund is with dividend stocks. Right here is a list of 10 of the highest paying dividend stocks in the index fund. Although I was saying the SPY 500 can hold bad stocks, the criteria to become one of those 500 stocks is still pretty hard to obtain. So just looking at this list, these are 10 stocks that are paying a dividend yield more than that 6 to 7% that the index is on average returning every single year. And the reason getting paid a dividend yield around 6 to 7% can actually crush the returns of the index fund is because when you reinvest that dividend, your portfolio grows 4 times faster than just getting 6 to 7% per year in the index fund. Meaning you can retire, quit your job, and become a millionaire 4 times faster. I won't get into the specifics about dividends, but the best investors of all time all flock towards dividend paying stocks. And the second best way to beat the index fund returns is with a mutual fund. And this can be a scary word, I understand, but the whole reason the mutual fund was created was to beat the returns of the index fund. That was its sole purpose. And the way mutual funds can beat index funds is because they're actively managed. Just like that example I gave you earlier, GE was just a bad investment at $35 when they cut their dividend and had plenty of bad news come out. Most investors would have sold, but the index fund could not. So having something actively managed is a huge benefit to you, and that's what mutual funds do. You basically pay a small percentage each year so you can have smart investors looking at all the stocks they're holding every single day. If you still think that it's impossible to beat the index, then how come thousands of mutual funds consistently beat the index for multiple years? I think this fact alone disproves this whole theory that the index fund is so hard to beat long term, because plenty of people, plenty of mutual funds have done it, and they have track records, decades of beating the index fund, and you can invest in these, and this basically gives you an extra 1 to 3% per year, which really adds up in the long run. Again, if you don't believe me, here's an article where somebody found 17 mutual funds that have beat the index for the last 17 years. Crazy, right? You don't have to know anything to beat the index. You just need to find the right mutual fund to do it. So in this case, beating the index is just a matter of finding the right mutual fund. And lastly, the third best way to beat the stock market index is to do your research. This is something nobody really understands how to do, but it's so easy. 5 minutes a day, 5 minutes a month, 5 minutes a year could really help you beat the index. One YouTube video, one article, one person you meet in your life could do this too. Or maybe one trading course, link in the bio, check that out. All you really have to do is understand what a moat is and how to identify it. And when you find that moat, all you have to do after that is to identify if it's getting stronger or weaker over time. And the only way to do that is through earnings reports, as well as listening to the earnings conference calls. The other option is you could just look at what the best investors are investing in. So Warren Buffett's 17 stocks can be found at line at any moment, and most importantly, you can see what he's buying, what he's taking off of. The whole concept of doing your own research could be as easy as just looking at what the best investors are buying. So this last way of beating the index is what Warren Buffett did. This is how he became the third wealthiest person in the world today. All he does is he goes to work and he reads financial statements. He tries to understand companies internally to see if they have an edge, if they have a moat and a competitive advantage that can be maintained over long periods of time. And if you want to do something similar, I'm sure it'll pay you plenty of dividends in the long term. All it takes is understanding how to read financial statements. But like I said, it could just be 5 minutes a day when you go home from work. Just read up on some companies, learn about new companies, and figure out if you want to invest in it or not. The best way to learn is by doing, and the best way to learn the stock market is by investing in it. So just going over the 3 best ways to beat the stock market over time. Number 1, find dividend paying stocks that have more than 6 to 7% yields. Some of these stocks are in the SPY 500, and the criteria to become one of the stocks is pretty tough to do. The second way to beat the index long term is mutual funds. Plenty of mutual funds have actually done this, and 17 have done this for the 17 straight years. And the third way you beat the index fund long term is you do your own research. You understand the company and you read up financials as they get released. The most exciting option to me is mutual funds because you can find good investors and have them invest for you. So check out this video as I dive into what a mutual fund is exactly. Did you know you can have the best stock pickers invest for you? This can be done with mutual funds because you can utilize their knowledge to invest for you. You no longer have to know anything about the stock market to beat the returns of the overall market.